Here's the solution before I give you the problem. There is a legal structure used by the Rockefellers, the Waltons, and virtually every family that has held on to serious wealth for more than 2 generations that lets you lend money to your own children, charge them interest, and then keep that interest inside your family's financial system forever. No bank collects it. No institution touches it. It grows inside a tax-protected structure and funds the next generation's loans, and the one after that. It is called a private family bank, and it is the reason the wealthy never really lose. Now here is the part that should make you uncomfortable. You have probably never heard of this, and that is not an accident. Because if the people sitting across the desk at your local bank or brokerage explained how a family bank works, if they showed you the math on internal lending versus commercial lending, you would stop sending your family's interest payments to them. So they do not tell you. They recommend products instead. Products that keep the interest flowing their direction. What I am about to walk you through today will change the way you think about moving money inside your family. Permanently. And it is more urgent in 2026 than it has been in any point in the last decade because there is a tax cliff coming that is going to hit families who have not built this structure before the exemptions expire. And I will explain exactly what that cliff looks like in just a moment. Stay with me. Everything you need to build this is in this video. Before we get into the blueprint, I need to say something directly. Most financial content, most of what you see on this platform is built for followers, people who are trying to catch up to a system that was designed by someone else for someone else's benefit. Follow this fund, copy this portfolio, wait for this legislation to pass. That is the follower's game, and the follower's game has a ceiling. Here at WealthForge, we do not play that game. We do not follow the market. We design the moat. That phrase is not a tagline. It is a distinction. It is the difference between a family that accumulates wealth and a family that builds infrastructure around that wealth so it cannot be touched. Not by market cycles, not by bad legislation, not by probate courts, not by a 40% federal estate tax. In a world of followers, we are the architects of our own freedom. And that is exactly what today's episode is. It's an architectural blueprint, not advice, not suggestions, a structural framework for building something that outlasts you, protects your bloodline, and compounds without you in the room. Here's what we are covering today, and I want you to know this up front so you stay for all of it. First, the 2026 tax cliff. Why this year matters more than any year in recent memory for estate planning and who is in the crosshairs right now. Second, the actual architecture of a private family bank. What it is, how it is legally structured, and the role of the family banker inside it. Third, the internal lending mechanics, the math that proves why keeping your family's interest payments inside the family system is one of the highest ROI moves available to you right now. Fourth, the vaults, the 2 structures, one of which almost no one outside of family offices knows about, that shield your assets from the death tax for generations. And fifth, the governance blueprint, the 90-day roadmap to go from where you are today to an operational family office model, including the one document most families never create, the document that determines whether this survives you. That's what we are building today. Let's start with the clock. Let me give you the number that changes everything. $13.61 million. That's the current federal estate exemption for an individual, roughly $27 million for a married couple. It means that as long as your taxable estate falls below that number when you die, the federal government does not collect estate tax. For most people, that sounds comfortable, more than in a front way. But here's what changes this year, and I want you to hear this clearly. That $27 million exemption was created by the Tax Cuts and Jobs Act of 2017, and it was always written with an expiration date. That date is December 31st, 2025, which means we are already inside the window, right now, today, where that protection is technically in its final hours. If Congress doesn't act to extend it, the exemption reverts to its pre-2017 level. Adjusted for inflation, that lands somewhere around $7 million per individual, $14 million for a couple. Now, do the math on that for a moment.
If you own a home worth, say, $900,000, a business valued at $3 million, a retirement portfolio of $1.5 million, life insurance with a $2 million death benefit, and some investment real estate, you're already at $7.4 million before you factor in anything else. And everything above the new exemption threshold gets taxed at 40%. This is not a problem for billionaires. This is a problem for business owners, for real estate investors, for physicians, attorneys, and entrepreneurs who have spent 30 years building something real. People who never thought of themselves as having an estate planning problem, because under the old rules, they didn't. Under the new rules, they absolutely do. And here is what makes this especially dangerous. Most families are still operating on a model that was designed for a simpler era. Accumulate wealth, write a will, hope the kids sort it out. That model fails in 3 places simultaneously. It fails at the moment the will enters probate, a public, expensive, time-consuming legal process that could run 12 to 18 months, during which your heirs have limited access to the assets they need while the tax clock is running. It fails at the tax calculation because a taxable estate above the new exemption is going to generate a bill your heirs have to pay in cash, which often means liquidating assets in a hurry at unfavorable prices. And it fails at the generational level because it treats wealth transfer as a one-time event rather than an ongoing system. There is no structure to sustain, no mechanism to compound, just a check, and then it resets. The families who have figured this out, and I mean the ones who have actually protected multi-generational wealth, not just accumulated it, they stopped thinking about inheritance as an event a long time ago. They think about it as infrastructure. And the centerpiece of that infrastructure is the private family bank. Before I explain exactly how it works, I want to make sure you understand one thing. This is not a strategy that requires you to already be wealthy. It's a strategy that helps you stay wealthy once you start building. The entry point is lower than you think. Keep watching. Let me paint a picture that is going to reframe the way you see money moving inside your family. Right now, in most families, capital flows in one direction, out. Your child needs $80,000 for a first home. They go to a commercial bank, they pay an origination fee, they sign a 30-year mortgage at 7%, and over the life of that loan, quietly, in the background, automatically, $537,000 in interest payments flow out of your family's economic universe and into the balance sheet of an institution that has zero stake in your family's future.
That number again, $537,000 on an $80,000 loan. That is not a mortgage. That is a wealth transfer away from your bloodline. Now, here's what changes the moment you build a private family bank. Your child still borrows $80,000. They still build equity in that home, but now the loan comes from a family-controlled lending entity, structured as a family limited partnership, a family LLC, or in more advanced cases, a Foreman family office trust structure. The interest rate is set at the IRS-mandated applicable federal rate, which historically runs well below commercial lending rates. And the interest, every payment, flows back into the family trust. Not to a bank, not to a fund manager, to your family's own balance sheet, where it recapitalizes the pool, where it becomes the seed capital for your grandchildren's first business loan, where it compounds year after year inside a structure designed to outlast every person in the room. I want you to really sit with what just happened in that scenario. The same need, a child who needs capital to buy a home, produced 2 completely different outcomes depending on where that capital came from and where the interest went. Nothing about the child's life changed. The home is the same, the equity buildup is the same, but in one scenario, $500,000 left your family forever. And in the other, that same $500,000 stayed inside your system, building, compounding, funding the next generation's entry points. That is what architecture does. It changes the direction of the math. Now, let me walk you through how this is actually organized, because the legal scaffolding matters.
The backbone of most family bank structures is either a family limited partnership or a family LLC. These are legal entities that hold the family's assets, real estate, investment portfolios, business interests, cash reserves, under a unified structure that the family controls. Inside that entity, there is a designated role I call the family banker. In smaller family structures, this might be one person, typically the wealth builder or a trusted family member with financial literacy. In larger, more sophisticated operations, it is a small committee. Some families bring in a professional trustee or family office administrator to fill this role. The family banker's job is to manage the lending function. They set the internal interest rates, which, to stay compliant with IRS rules, must meet or exceed the applicable federal rate. They approve loan requests based on the family's established criteria. They maintain documentation, promissory notes, payment schedules, annual trust accounting. All of it formal, all of it defensible. This is a critical point that most people miss when they first hear about the family bank concept. The structure only works, legally and financially, if it is treated like a real institution, not a favor, not a handshake, a governed system with written rules, documented transactions, and a clear decision-making process. That rigor is not a burden, it is the feature, because it is what keeps the IRS from reclassifying your internal loans as gifts, a reclassification that would destroy the tax efficiency of the entire structure. When you give your child $80,000, that is a gift. It leaves your estate. It has gift tax implications above the annual exclusion, and it's gone. No asset on your balance sheet, no interest returning to your system, no mechanism for recovery. When your family bank lends your child $80,000, that loan is a receivable asset inside the trust. It has value. It earns a return. It reduces your taxable estate by moving assets into the lending entity while simultaneously creating an income stream that stays within the family structure. The same $80,000, a completely different financial outcome. That is the power of structure over intention. Coming up next, I'm going to show you the math on how the internal lending mechanics work over a 30-year window and why the compounding effect inside a family bank makes the commercial mortgage look like one of the worst financial deals most families ever agree to. Stay with me. Let's run the numbers, because this is where most conversations about family banking stay vague, and I think that vagueness costs people a lot. I'm going to model two scenarios side by side. Same borrower, same home, same 30-year window. The only variable is where the money comes from. Scenario A, commercial mortgage, $400,000 home purchase, 7% interest rate, 30-year term. Total interest paid to the bank over the life of the loan is $537,016. At the end of 30 years, your child owns a home and an external bank collected over $500,000 from your family. Scenario B, family bank loan. Same $400,000 purchase, interest set at the current long-term applicable federal rate, let's call it 4.25% for this model. 30-year term, total interest paid approximately $313,000. Your child still owns the same home, but now that $313,000 in interest payments has returned to the family trust across 30 years. The difference between those two scenarios is $224,000. That's the amount of capital that stays inside your family simply by changing the source of the loan. No additional earning, no investment genius, just structure. And here's what makes that $224,000 extraordinary. If the family trust reinvests those incoming interest payments at a modest 6% annual return over 30 years, and I'm using 6% deliberately because it's conservative, that capital base grows to approximately $620,000. $620,000 generated entirely from interest payments on one loan that would have otherwise fed an institution that had nothing to do with your family. This is what the architects understand that the followers do not. The game is not just about growing your portfolio, it's about capturing the math that currently leaks out of your family's financial system and redirecting it inward. Every external loan your family takes is a transfer of compounding power away from your bloodline. The family bank is the mechanism that reverses that transfer. Now, let me add the estate planning layer, because this is where the family bank structure becomes genuinely elegant from a tax standpoint. Every dollar that sits inside a properly structured family limited partnership or family LLC is a dollar that can be valued at a discount for estate tax purposes. This is a legitimate IRS-recognized accounting principle called the valuation discount for lack of marketability and lack of control. Here's what that means in plain language. If you hold $1 million in a stock portfolio personally, that $1 million counts as $1 million in your taxable estate. But if that same $1 million is transferred into a family partnership where no partner can unilaterally sell their interest on the open market, the IRS allows a discount on the estate valuation of those partnership interests, typically between 20 and 35%. So that $1 million in family partnership interests might be valued at $650,000 to $800,000 for estate tax purposes, not because the assets are worth less, but because of the structural wrapper around them.
On a $5 million estate, that discount could represent $1 million to $1.75 million in reduced taxable value. At a 40% estate tax rate, that is a tax reduction of $400,000 to $700,000. Let me be clear, this is not aggressive tax planning. This is standard, well-established estate law. Family attorneys and CPAs who specialize in multi-generational planning use this framework regularly. The people who do not use it are simply the ones who were never shown it. We've covered the lending mechanics and the estate math, but the structure we have talked about so far still has a vulnerability. The death tax can still reach it under the right conditions. The next piece is the vault, and one of the two instruments inside that vault is something most financial advisors will never bring up in a standard planning meeting. I'll show you why in just a moment. Everything I have shown you so far, the family bank structure, the internal lending mechanics, the valuation discounts, all of it is powerful, and all of it is still exposed to one critical vulnerability. Your estate can still be hit. Not necessarily by the death tax on the partnership interests, we have addressed that through discounting, but by the accumulated growth inside the structure over time, by assets that have not yet been transferred, by the taxable estate that remains above the exemption threshold. The families who have truly solved this problem do not stop at the lending structure, they build a vault around it. And the vault has two components. The first is something most people have at least heard of, a Dynasty Trust. A Dynasty Trust is designed to hold assets for multiple generations. In many states, this now means indefinitely. When assets are placed into a Dynasty Trust, they are removed from your personal taxable estate. They grow inside the trust. They can fund distributions to heirs. And when those heirs eventually pass, the assets do not re-enter a taxable estate. They continue inside the trust structure. The key feature, the reason this matters in a 2026 environment, is that a properly funded Dynasty Trust largely eliminates the generation-skipping transfer tax, which is the tax designed specifically to prevent wealthy families from bypassing estate tax at each generation transfer. Without a Dynasty Trust, your estate gets taxed when you die, then again when your children die, then again when your grandchildren die. The same wealth taxed 3 times in 3 generations. With the Dynasty Trust, the assets move through generations inside the structure. The family bank keeps lending, the trust keeps growing, and the 40% tax rate does not collect its toll at every transfer point. Now, the second component of the vault. This one most financial advisors do not bring up in standard planning meetings, not because it's complicated, because it's almost exclusively used by people managing significant family wealth, and the advisory fee structures for the products that compete with this instrument make it financially awkward to recommend. It's called Private Placement Life Insurance, PPLI. Here's what it is, stripped completely from jargon. PPLI is a life insurance policy, specifically a variable universal life policy, that functions as an investment wrapper. Inside that wrapper, you can hold a wide range of institutional quality investments, private equity funds, hedge fund strategies, real estate investment vehicles, separately managed accounts. Normally, when those investments generate returns, dividends, interest, capital gains, you pay taxes on those returns each year. Inside a PPLI wrapper, that growth is completely tax-deferred. It compounds on its full value year after year without annual tax drag. And when the insured passes, the death benefit, which includes all of the accumulated tax-deferred growth inside the policy, transfers to the beneficiaries income tax-free. And when the policy is structured correctly and owned by an irrevocable trust, that death benefit is also outside of the taxable estate. Let me say that again more slowly. You are growing capital inside this structure with no annual tax on the growth. The total accumulated value, growth and all, transfers to your heirs without income tax, and it is not counted in your estate for estate tax purposes. 3 layers of tax protection, simultaneously. Now I need you to understand why you have almost certainly never heard of this. PPLI is not sold through retail financial advisors. It requires a minimum investment, typically $1 million or more, to access the most efficient structures. It bypasses the mutual funds and annuities that generate commissions for the advisory industry, and because it competes directly with traditional investment vehicles that pay fees and commissions to distributors, there's very little financial incentive for the people most people interact with to explain it. This is a tool designed for wealthy families by the financial infrastructure that serves wealthy families, and it's been largely invisible to everyone else, until right now. Put these 2 structures together, and here's what you have built. A Dynasty Trust that holds the family limited partnership. The partnership operates the lending function, the family bank. The bank is funded in part by PPLI policies, generating tax-free returns. The trust holds assets at a valuation discount. The PPLI grows the vault outside the estate, and distributions to heirs bypass probate, bypass generation-skipping transfer tax, and arrive income tax-free. This is not a workaround. This is the architecture. This is what we mean when we say we design the moat. A wall on one side, a vault on the other, and a bank in the middle that keeps your family's capital working inside the bloodline for generations. The last piece, and honestly the one that determines whether any of this survives contact with the real world, is governance. The 90-day roadmap is coming up next. This is the part most financial blueprints skip entirely. Don't skip it. I want to pause the financial architecture for a moment, because here's something I have seen happen with families who do the legal work, who set up the partnership, establish the trust, consult with the right attorneys, and then watch the whole thing quietly fall apart within a generation. Not because the structure was wrong, because no one taught the family how to use it. Money moving inside a family without a governance framework is not a strategy. It's a family conflict waiting to happen. I have seen family banks collapse because one sibling felt they were owed a loan that the other sibling did not agree to. I have seen them unravel because the person who understood the structure died without documenting how it worked, and nobody else knew the operational details. I have seen them get reclassified as gifts by the IRS because the promissory notes were never signed and the interest was never formally collected. The structure is the blueprint. Governance is the building code. And without the building code, even the best blueprint reduces a structure that doesn't survive. So let me ask you this directly. If something happened to you tomorrow, not hypothetically, but actually tomorrow, does anyone in your family know where the assets are held, how the entity is structured, what the lending criteria are, and who's responsible for making decisions?
If the answer is no, or even sort of, then the structure you build will not outlast you by much. That changes with one document. I call it the Family Constitution. The Family Constitution is not a legal document in the traditional sense. Your attorney does not file it. It is an internal governance manual for the family bank. It covers 5 things. 1. Borrowing criteria. What qualifies as a productive asset eligible for a family bank loan.
First homes, yes. Business startups with a plan, yes. Consumer spending, no. Vacation debt, no. These lines need to be written, agreed to, and visible to every member of the family who might one day borrow. 2. Interest rate policy. How does the family bank set its internal rates? Does it default to the applicable federal rate? Does it set a fixed spread above the AFR? Who reviews and adjusts this annually? 3. Repayment standards. What happens if a loan goes unpaid? Is there a grace period? Does unpaid principal get deducted from inheritance? These are uncomfortable conversations, but they are far less uncomfortable before someone misses a payment than after. 4. Decision-making authority. Who is the family banker? What is the process for replacing them? If decisions are made by committee, how are disputes resolved? 5. Onboarding new family members. When your child marries, does their spouse gain access to family bank borrowing? What is the process? This protects relationships by removing ambiguity. This document does something that the legal structures cannot do on their own. It transforms the family bank from a financial tool into a family institution. And institutions survive their founders. Tools often do not. The families who have done this correctly, who have the trust, the entity, the PPLI policy, and the family constitution, those families have moved from being accumulators to being architects. They have stopped asking how to protect what they have built and started building the protection into the system itself. That is who this channel is built for. That is the shift we make here. Now let me give you the 90-day action roadmap, because this is only useful if you move. Days 1 through 30, clarity phase. Your first job is to see your full picture with precision. Pull together every asset, real estate, business interests, retirement accounts, life insurance death benefits, investment portfolios. Get a current valuation estimate, then work with an estate attorney, specifically one who specializes in multi-generational structures, not just wills, to model your exposure under the revised exemption landscape. Ask them directly, if the exemption drops to $7 million this year, what is my estate's tax exposure? That number will tell you exactly how urgently you need to move. Days 31 through 60, structure phase. This is where the legal scaffolding goes up. Work with your attorney and a qualified CPA to establish the appropriate entity, family limited partnership or family LLC, based on the size and nature of your assets. Begin the PPLI conversation with a specialist, not a generalist insurance agent, but a firm that specifically works with these instruments for estate planning purposes. These conversations take time. Starting them now is what puts you ahead of the families who will scramble when the exemption change becomes final. Days 61 through 90, governance phase. Draft the family constitution, set up the accounting infrastructure, promissory notes, payment tracking, annual entity reporting, and have the family conversation. Not just with your spouse, with every adult member of your family who will eventually interact with this structure. Walk them through the criteria, explain the lending mechanics, let them ask questions. Because a system that only one person understands is fragile. A system that the family understands is a legacy. I am going to give you one final thought, and it's the one that changes the emotional context for everything we've covered today. Stay with me for 2 more minutes. It's worth it. Every generation gets one window, one period where the financial environment creates a gap, a moment where the people who move intentionally can build something that the people who wait simply cannot replicate later. For the generation before ours, that window was real estate in the 1970s, before the prices, before the demand, when you could buy a building for what a parking space costs now. For our generation, for right now in 2026, the window is structural wealth protection. The estate tax exemptions are changing. The cost of not having this structure in place is about to be measured in hundreds of thousands of dollars per family, per generation. The families who move this year are going to look back at 2026 the way that prior generation looked back at the moment they closed on that first building. We do not follow the market here. We design the moat.
A family bank is a moat. A dynasty trust is a moat. A PPLI vault growing tax-free for the next 50 years is a moat. A family constitution that teaches your heirs to steward what you built instead of dismantling it the moment you're gone, that is a moat. You did not build what you have built to hand 40% of it to a tax code. You built it to hand it forward. Here's what I want you to do right now, not tomorrow, right now. Find the one person in your financial life, an estate attorney, a CPA, or a family office advisor, and send them this video, or bring them the 3 questions that will tell you immediately whether they're the right person to help you build this. Question 1. Have you set up a family limited partnership for estate tax purposes before? Question 2. Are you familiar with private placement life insurance as an estate planning tool? Question 3. Have you worked with dynasty trusts designed to survive generation-skipping transfer tax? If they say yes to all 3, you have the right person. Start building. If you found this valuable and you want to go deeper, I'm building a complete breakdown covering the Dynasty Trust design process, the PPLI qualification criteria, and a step-by-step family limited partnership setup guide specifically for the 2026 estate tax environment. Drop the word architect in the comments and I'll make sure that resource reaches you directly when it goes live. And if you're just discovering this channel, the next video I want you to watch is the one on how the family office model works for families at the $2 million to $10 million net worth level, because most of what you see about family offices assumes you're already at $50 million, and that's not the reality for most of the people building serious wealth right now. I'll link it right here. This is not the end of the conversation. This is the foundation, and we're just getting started.